Good morning and welcome to the KINOVO PLC full year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives in the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll, and I'd now like to hand you over to David Bullen, CEO. Good morning to you, sir.
Good morning, and good morning to everybody. Thank you for taking the time to log in and welcome to the presentation of KINOVO's full year final results for the period ending 31st of March 2023. In terms of the presentation, we'll go through the financial highlights, cover off the operational highlights, give you a snapshot of our financial summary, and with that, go into elements relating to delivering our growth strategy. We'll follow that off in terms of an outlook and with that then move to questions. Starting off with financial highlights, I'll pass over to Clive Lovett on my left, who is our Group FD.
Good morning. I'll be fairly brief on this slide. We've got further slides to come, which we'll go into a little bit more detail, but really just to give a very, very quick overview. With revenues up 18%, going down to EBITDA up at 29%, and further increase in percentage down to earnings per share and profit before tax. I'll take you through a little bit more of the detail as to where, but a strong overall position in terms of our growth on our continuing operations. That's gone through into our cash, so we're happy with the cash conversion that we've achieved there. And that's allowed us to repay all of our HSBC term loan, which at the beginning of the year was 2.5 million. So that's fully repaid. That's actually slightly ahead of schedule as well, and I'll come back to that as well. And we end up with a net cash position at the end of the year at 1.1 million against a net debt position of 0.3 million. So we're happy with that as well. Visible revenues is a place to probably stop and pause and actually have a look at that as well. So our visible revenues, we don't call it order book. It's actually what we have visible over the next 3 years rather than an order book, which might go forward up to 10 years. So it's very much sort of giving that sort of shorter period of time visibility and is very much around what we can see in terms of contracted revenues that are coming in over that period. And that's up at 146.4 at the moment, so an uplift on prior year, and a significant proportion, in fact, the vast majority of our revenues are recurring. So we've got that visibility and the recurring revenues coming through, and that's to the extent that we can actually see have visibility that for FY24, so i.e. the current financial year that we're now in, that we can see that we've got revenues around about 64 million that are visible to us for this current financial year. And that's obviously is actually more than the full year that we actually reported in FY23. So we're seeing good progress and the business moving forward and growth being delivered through that. And just finally, final point on this slide really is that a significant proportion of our contracts have actually got elements of price index linking to them. So there's elements and different ways that they work, but they're price index. So has allowed us, and we'll talk a little bit later as well in terms of some of the margins and maintaining margins and growing margins. And within the tough economic positions and inflationary positions that we're in, we've been able to, partly through this contractual position, to be able to maintain and grow our margins.
So moving on to the operational highlights, in terms of the business overall, we continue to benefit from the legislation drivers and a streamlined focus through our repositioning in terms of our 3 key strategic pillars, that being regulation, regeneration, and renewables. With respect to regulation, this contributed to a total of 50% of our revenues last year, with regeneration coming through at 28%. And really being the significant growth driver at 69% growth during the year, alongside renewables, which accounted for 16% of our revenues. Clive has slightly alluded to it, and we'll go into this in more detail further down the presentation as well. but our operational efficiencies have continued to mitigate the inflationary pressures that are well known throughout the country. Gross margins increased 2.4% up to 26.3%, and our EBITDA margins also strengthened up to 8.7%. We've been pleased with our investment in terms of the commercial team, business development team, and we've seen that come through in terms of a number of wins, including a 5-year contract with a Hyde Group at a value of 25 million for electrical testing and associated works, offering a potential value due to the option of a 3-year extension to an overall value of 40 million over 8 years. Alongside that has been a 4 million contract over 2 years with the London Borough of Waltham Forest. This is particularly pleasing as it encompasses our 3 key service divisions, that being the electrical side, the mechanical side, of which this is specifically related to the commercial mechanical side, and our associated builders works. One thing that has been particularly opportunistic and pleasing in terms of our business development team has been a number of framework wins, which again will go into more detail further in the presentation. So I won't explore that too much now. We'll cover that off as we move on. But that has been a very positive potential for us. It may be opportune to emphasize at this stage that there are no associated revenues from any of these framework wins that we account for in our visible revenues. So that is all upside potential in terms of our biz revs and our growth perspective. Further on from this, we've continued to focus and deliver on our ESG commitments. Our energy consumption reduced by 23% over the period, and our carbon emissions reduced by 22% a period. In terms of electric vehicles, by August this year, we expect to have 10% of our fleet in terms of electric vehicles. And alongside this ESG commitment, you may well have noted through our RNSs that we have had strong accreditation process in terms of Trust PAS 2030 certifications, expanding that well beyond our traditional PV, air source, ground source. And again, we have a slide specifically on that to elaborate in more detail. Reference to the legacy DCB Kent projects as part of our discontinued operations. We're pleased to announce that we've made significant headway in this regard. Estimated net cost to complete relating to these projects continues to be 4.3. There is a 5.3 loss reported in the year 31st of March 2023, with 1 million of these being anticipated recoveries that will be recognised in future periods when they've been realised. 7 of the 9 projects have reached agreement in terms of contract terms and expect to be completed by the end of the financial year. 7 of these 9 projects are actually now on site with works being carried out. It's worth noting that within that 7 of those 7, all potential LADs have been removed, and there's been extensions provided in terms of completion dates as part of that reset. And alongside that, within those 7 were 2 performance bonds, one of which has been cancelled, and the other has been novated. Reference the final 2 projects. We've submitted heads of terms to clients and obviously hope to conclude and agree contracts as soon as possible. So if we move on to the financial summary and the income statement, I'll pass back to Clive.
Yeah, so just a fairly simple table illustrating the income statement and the variances that we've got there. If I start at revenues, spoke about that previously in terms of revenue, 18%. Actually, very good growth in our electrical services and building services. So very pleased around that. The mechanical services has actually gone down a little bit. It's actually more a proactive transition away from a client, a non-core client. So we are actively moving away from that, but in the short term, we've then seen that sort of small decrease in mechanical services. But we've seen then that flow down to both the gross profit level and the EBITDA level, with gross profit margins up and EBITDA margins up as well, and overall a 29% increase in EBITDA, all of which is obviously organic growth. Good margins as well on each of the different areas, and we're seeing that particularly with electrical, where we've seen the increase in the proportion of electrical and then the proportion of that higher margin work coming through as well, which has been a strong driver to the results. I think that really probably only a couple of other things really to mention on this slide, and the first of which is our non-underlying items, which are non-cash items, as amortization on acquisition, legacy acquisition balances, which is actually now fully amortized. So you can see that there's been a significant reduction in that over the years, and actually that proportion actually goes down to zero as it's fully amortized. And then there's just a small charge that's left on other areas, but relatively small and immaterial in terms of the overall scheme of things. And then finally, from my perspective, just on tax, we haven't. There's a tax charge in there, but we actually have not got any tax payments. We've not had any tax payments over the last couple of years. We are starting to move. We do have some tax losses that we will be carrying forward, which will mitigate, but we will be starting to move back into a corporation tax payment position in future periods. And then just finally, just the bottom slide there really is, with all of those elements coming together, we're seeing EPS going up by over 60%, which is driven by that 30%, 29% increase in EBITDA, and then the reduction in the non-underlying items as well, going through to the bottom line. Just talking a little bit about cash, and the table here, and there's a sort of a very easy sort of waterfall graph to come on the next slide. But really that's just showing the cash conversion that we've seen has been very strong, slightly more normalized in this year than in previous years where there were other factors that were really driving that. And this year, I think that we're probably fairly comfortable with where we're at. Actually, I mean, a pretty decent, although it's at 107%, I think that's probably more around about the 90 to 100%. There's other various elements in there. In the bullet point there, I referenced that we actually got some cash in advance at the year end. So I think that's probably more driven by our clients' budgets and how they wanted to spend them, but we obviously account for that in cash perspective. It's not a P&L impact, but obviously has accelerated some of the cash and has driven us above that 100%. Cash is a significant driver for us. It's all-encompassing to us as we move that forward. So we're pleased to see that result continuing to come through. In terms of capital expenditure, we're very low capital intensive. We have a region somewhere in around 250 to about 400,000, which that would be normalized, and that's how we would see that going forward as well. It's really sort of just your general IT equipment and building improvements, and that's it. And the final element on this slide, which we've spoken about a little bit in terms of DCB from a profit and loss account perspective, from a cash perspective, we've seen a total of just under 2.8 million going out. 1.2 million of that actually relates back almost a year, or over a year actually, back to April 22, prior to DCB going into administration, and was related to some of the terms of the disposal. So the balance of that, the 1.5 million that you see there, is the cash spend that we have on the completion of the 9 projects that David referenced earlier on. So we're starting to see that going through. We are expecting that now to ramp up in this financial year as we have 7 out of the 9 on site, and we have the other 2 in productive and advanced discussions, and hopefully we can convert those into contracted and on-site projects in the relatively near future. So we will see that uplift. Part of the cash position that we had at this financial year end is some of those cash flows that we've seen on DCB have moved right, as we've been gradually getting it will move right against our original expectations, at least, as we were gradually getting them to be on site, but have taken a little bit longer than we originally expected. And the final slide for me, just very simple, just illustration of the moving elements of our cash flow, which is pretty simple in terms of where we're at. The green is that 107% with the working capital uplift against the underlying EBITDA, that cash conversion. One element that I didn't reference was the deferred VAT. So we did at the end of last financial year have some VAT that we deferred from normal terms in agreement with HMRC. That was fully repaid in the period, so that's now completely normalised. And the other elements I've spoken about or are relatively immaterial. So in terms of your capex and some interest, and then the DCB payments, giving us that waterfall and fairly simple illustrative elements of the different elements of our cash flow.
Thanks, Ben. So if we move on in terms of some of the drivers behind delivering our growth, one of our objectives, as certainly our current shareholders will be aware of, is to drive accelerate our organic growth. So looking at that slide, there's two parts of that matrix. One is the overall breakdown to try and give you some color and transparency in terms of our service divisions and our three key strategic pillars. And the other one is the related increases in percentage growth over previous year. Out of those three, focusing in terms of the service division themselves, mechanical in the year accounted for 24% of revenues. With that, then electrical was 45%, and the remainder, in terms of the 31%, was with building services. In terms of the three strategic pillars, regulation continues to be our foundation, and is being driven by these ongoing legislation changes. I have alluded previously, obviously, through the tragedy of Grenfell, there's been a number of legislation changes that came in during the year, notably the Building Safety Act, Fire Safety Act, as well as upgrades in terms of electrical wiring legislation. And that's fundamentally what's fed into that 41% growth on that electrical side, and allowing us that 13% growth in terms of regulation. What, again, a lot of our shareholders will well be aware of is regulation is there from that compliance perspective. Obviously, as you're carrying out testing and undertaking that compliance and regulatory responsibility, there will be remedial work that comes out of that alongside additional planned works, and that feeds into regeneration. And regeneration clearly had very strong growth out of that last year in terms of 69%, and all three work streams in terms of the mechanical, electrical, building services side demonstrating strong uplifts in that regard. So we move on to the renewables, and as Clive alluded to that last year, certainly the renewables predominantly focusing on that mechanical side has dropped over the year. This is very much a transient, temporary drop, and has been driven fundamentally as part of a strategic rundown from our side of private sector work. The private sector work that we've been undertaking is fundamentally as an agency in terms of overseeing and managing that work. We want to reallocate the team with regards to that, to our hands-on own direct work, and therefore over the year have been strategically running that down, and therefore emphasize that that is a temporary transient scenario which will address itself this year. With regards to renewables, and again, there's more slides on this when we go into the framework wins and these past 2030s accreditations, as well as the government release in March this year of 778 million, which will be match funded to the tune of 1.1 billion. Out of that 778 million, and this is publicised on the government website, there is a list of direct clients that account for circa 140, 145 of that 778 million within our client base. So that gives a snapshot overall of the three key pillars in our three key service divisions. Looking then in terms of how that has developed over the last 3 years with respect to the continuing operations and our revenue growth and EBITDA growth, all very positive in terms of that direction of travel. In terms of our growth drivers moving forward, we've continued investment into our business development team to capitalize on the momentum we've had. We've been very cautious and strategic in terms of our investment internally. And through the success of that and the success that is demonstrated in a number of our wins, we have continued to invest in that further this year to increase that momentum. We've increased our marketing and networking efforts externally to continue to strengthen the recognition and reputation of the organization. I think this has been proven in terms of looking at our client base and the fact that over 20% of our client base are new clients, and we expect that to continue as we move forward, focusing on geography, consolidating our position within that, but diversifying the client base as we move forward. Without question, legislation and decarbonisation will continue to be the driver for market potential for all our work streams. And again, hopefully through the presentation, you'll get a little more flavour on how that will be impacting in terms of the relevance to our business and the opportunities that lie within that. Previously mentioned the framework wins, like I said, the PAS 2030 and the SHDF. In particular, in terms of those frameworks, we have a robust pipeline of opportunities in play as we speak. And we expect to report further on those in due course. And again, everyone is well aware of the labour challenges nationally per se, but particularly in our sector, labour challenges are significant. And we actually see that as a potential opportunity because of the hybrid model that we have, both between direct labour and our breadth of subcontractors that we utilise and continue to expand. We see an opportunity to capitalise on those challenges moving forward within the sector. So if we move on to another driver for us in terms of delivering growth, investing in our people and our communities is a commitment for us. In terms of the summary of the blocks, internal headcount increased over the year by 5%. There was internal progression opportunities for staff that accounted to 9% of our employees having some form of progression within the year. And then in terms of wage inflation, again, looking across the group, again, everyone is aware, obviously, with inflationary challenges, etc. We were ensured we maintain our competitiveness in that regard, and wage inflation has increased by 5% across the group over the year. Regarding our people focus and our continued development of our people and allowing that career progression opportunity, I think this is relevant when you take into context of obviously the wider challenges in the sector. Recruitment is one side, retention is the other. We have very, very strong retention rates that I'm pleased to say, and we have a strong commitment to allow that opportunity for our staff to develop and maximise their potentials as individuals and within the business. So we completed the final round, should we say, in terms of leadership and management development training across the business with 72 employees taking part. For us, this solidifies and substantiates our culture, our ethos, our expectations, and allows that development process within our staff. Across the piece in the group, we invested 3,676 hours in terms of personal and professional development on a general scale as well as individualistic focus across the group. We've carried out an employee engagement survey during the year. 69% responded very positively in that regard. A strong response rate, positive response rate, which demonstrates the progress we have made as an organisation as a whole. We have since followed up from that engagement survey, a follow-on survey, to assess what else the company can do for our people. And I'm pleased to say that the resounding standout there was that career development progression process, which we have firmly ensconced within the business. In terms of social value, again, very important from our perspective, and certainly within the environment that we work. By the nature of our work in terms of dealing with social housing and affordable housing, we are at the heart of this ESG perspective, and social value is critical as part and parcel of that process. We have seen through government guidelines that tendering processes will require 10% of the value of that tender process to be evaluated on social value. However, as an organisation, we undertake social value not necessarily because we need to, but because we want to be able to give something back to society in that regard. So we've spent 486 people hours in terms of supporting the local community with 50,000 worth of donations from the organisation in that process. We've also spent 54 people hours in terms of education engagement. This flows down into our apprenticeships, where apprentices account for 14% of our staff, and there has been a number of apprentices completed through the year, and we continue that pipeline. I think for us it's important to have that pipeline flow, particularly from the engineer operative perspective, in terms of that skill base. As I've already mentioned, there's labour challenges in the market, and we need that pipeline moving through, and with that offer these ambitious youngsters the opportunity of seeing a career from the tools and over and beyond the tools, should they wish to progress within an organisation. That's very important for us, and we'll continue to focus on that as a priority moving forward. The added advantage of that apprenticeship roles within the business is, of course, the efficiency perspective from an operational perspective. I've mentioned this before, where by default health and safety requires 2 people on site. You could utilise the qualified engineers to be doing the work whilst you're having support from apprentices, as opposed to having 2 qualifieds in a support role and implementation role. And through that comes that learning process to allow them to develop further. Moving on to the next one, which is expanding our core competencies. This comes back then to this past 2030 element, and I'll pass on to Lee Venables on my right, who is our COO.
Good morning, everyone. As David touched on very briefly to start some of his slides, this time last year, from a PAS 2030 compliancy and accreditation elements, we focused very much on the mechanical and the electrical arm, which allowed us then to do the PV, the air source, the ground source, and the battery storage element. Since then, this year is very much the focus has been onto this fabric first scenario. So we've gone out and actively expanded our accreditations, and I won't read down the 10 to 12 that are on the slides, but our thought train around this is we've seen lots of the tenders, the frameworks that are out and in play, and one of the key questions on the tenders is, do you hold the ticket to play in regards to the fabric first? Now, lots of our competitors have relied on subcontractors to hold that ticket. We've got ahead of the game and now hold the ticket directly, and are able to now be in front of others in our industry. Why is this good? Because with the framework opportunities that come along, because we hold the ticket, there isn't enough accreditors to come along. So the time frame now for others to get this ticket is going to be elongated. We've done that, and we've put a lot of effort, time, investment into those accreditations. I mean, the office that we're currently sat in and doing the presentation from was a showpiece for the assessors. We've got the MVHR units in here, we've got the floor insulation, the wall insulation, the PV on the roofs. Again, why is fabric first important as we move forward? We've spoke with the SHDF funding, and I'll touch a little bit on that in a second. but the age of the properties that we are working in are old. It's no good just going in, putting an air source heat pump in when the windows are single glazed, because you'll lose all the heating straight out the windows. So part of our ongoing Fabric First approach is, let's do the insulation, let's do the roof, let's do the windows, let's do the doors, then the air source heat pump, so you get that whole house retrofit, and that's now starting to come to fruition. I mean, on the screen, you'll see a couple of photos. One of them was on the bottom right in a listed building, and that is actually sheep's wool insulation, because as part of the listed and the conservation area, it asked that we put the sheep's wool in. Wave 2.1 of funding is live, come out in March this year, and as David said earlier, 778 million of that has been made available in this funding, excuse me, of which is going to be match funded to the tune of 1.1 billion. And I'll reiterate that because that's fundamental in where we see some of our growth and expanding our core competencies. Again, as David said, 143 million of that is directly attributed to our key clients. So huge opportunity for us, because we've now got the ticket to play in this arena. And all three elements of our work complement each other: the gas, the electric, and now the building services, from the air source right the way through to that fabric first. Frameworks. I mean, there's a couple of slides now on frameworks. I won't read through them all, but why are frameworks important? From a client perspective, we know that there's budget cuts. We know that there's cost constraints. Now, that if members of frameworks are on board, it allows them to cut time, to cut cost pressures, and come to members and contractors that are on those frameworks and offer direct awards. Two different ways on frameworks, and we've got a mix of direct, where we're number one ranked, but we've also got opportunities where we can do mini quoting. Vast frameworks for us. I mean, there's a national framework on there, of which we are number one ranked in London, in the southeast, and in the east of the country. So it covers a vast arena for us to bring some of this SHDF funding into the game. Others on there, like the Hyde framework, is a conglomerate of 5 national contractor housing associations, one being Hyde, one being Sanctuary, one being Home Group, one being Abri, and another being Anchor. They've merged together. Of the 143 in the funding, 40.5 million is attributed to that Greener Futures Partnership. And over the last 3 to 4 months, we've seen lots of opportunities that are bubbling in the background, and we do hope to be in a position to start to share some of this good news as we can get these contracts across the line. Huge growth opportunity. The Greener Future Partnerships, for an example, whilst we're still in wave 2.1, there will be additional waves. That Greener Future Partnerships contract is 7 years. So whilst we're in this first 2-year period, there will be greater resource and greater funding to come as we grow through that 7-year period. Just quickly, sorry, David. On the right, we see some of the, David spoke about some of the events, and one of the key drivers in our industry is the Chartered Institute of Housing. We actually sponsored their sustainability theatre down in Brighton earlier this year, and had some real keynote speakers, including the director of the new DESNES government council.
Thank you. Moving on to another growth driver of ours in terms of importance, and what has contributed to our progress and will continue to do so, is improving our collaborative support functions. We've talked about a lot of this previously, our investment in that commercial team, that business development team, to name a few of these deliverables. One thing we did carry out in terms of work undertaken during the year it is very important for us as an organisation to seek feedback and to drive continuous improvement and continuous performance in the business. So during the year, we undertook a customer insight survey that involved face-to-face interviews, independently and anonymously, with clients, staff, as well as supply chain. This strengthened our understanding in terms of our partners' perceptions, and with that allows us to roll out initiatives to ensure that we continue improving our service and our offering within that. One driver within this, as I've already mentioned, has contributed indeed to the gross margin improvement. Lee, maybe you want to share a little bit about this in terms of the mix and how that's been delivered.
Yeah. So on the gross margin improvement, three component elements really for me. Electrical, yes, was a key driver, and we've spoke earlier about that from the legislation drivers that have driven that. Second element for us is we've done a lot of work internally from a commercial perspective, where we've reached out to wholesalers, subcontractors, and there's been a little bit of what we would call greedflation, where suppliers will put their prices up. So our commercial team has gone out to all of them. One particular wholesaler we put on stop and banned our engineers from going in there. Rolled full circle 2 months later, their prices have come down because we've had that conversation with them. So the commercial team have done an awful lot of work on drilling into the numbers and making sure that we're buying at the right prices. We've brought in a specific procurement manager. Now, originally commercial was an overlink with the procurement. That's now a specific key role for us in that procurement area, and that will continue to revisit not just wholesaler prices, but subcontractor prices to make sure that we are paying the very best rate. So it's been a key driver in the change of that gross margin. And the third element really is there's been a slight remapping within the accounts where some of the costs from cost of sales have been put into overheads.
I think Lee has made an important point there with regards to that greedflation perspective. Clearly, we are and have been in a backdrop of inflation, but I think there's been a number of organisations that have used that as an opportunity to capitalise on with respect to trying to raise prices. And I do need to emphasise that our focus during the year on that, and our continued focus moving forward to shake that tree. And despite that backdrop, you can see the end results in terms of some of those margin improvements, which we're pleased with and will continue to focus on moving forward. Part and parcel of that customer insight survey was some requests and requirements in terms of support from our client base in terms of sort of IT data related elements. With that, we've focused internally by undertaking a full review with regards to some of that feedback as well as opportunities for continuous improvement in our own sort of processes and services. I emphasize here that what we are about to go through in terms of that has been low capex in terms of requirements, but we're very confident in terms of the efficiencies and uplifts in terms of productivity with respect to these. Lee, maybe you want to share one or two of these as well with our audience.
I mean, there's quite some exciting stuff that we see we're doing now that from a technology perspective. We're upgrading our current CRM system to a new web-based version. Why does that excite me? Because it will give us greater visibility. I think we spoke last year where we've done a lot of work from a frontline engineer perspective on their productivity and efficiency. Well, this new web-based system that we're going to have in by the end of September will allow us to drill down into dashboard reporting that will sit on everybody's system, and these won't be of choice. We will have mandatory tiles that will sit within each person's system, and it will be stuff like jobs in progress, jobs out overdue, and this will be instant. The old system that we had, you needed to run through 2 or 3 different tables to get some of this key information. This will be clearly visible the moment that you open up our CRM system and give us that extra transparency and allow us to now drive further efficiencies from within the business that we've now, which will complement those engineers. There's stuff in there, for example, like a subcontractor portal, which historically we've had spreadsheets come in, we've had to manually upload, we've had to pick data up from here. It will allow us to get subcontractors to update that information on a daily basis, so that if an appointment cannot be made, if there's further works required, it will be live, instant information that comes into our system. On top of that, it will allow them to cost and code their own jobs. This, again, we spoke about cash conversion. This will allow us to increase that order to cash cycle, because if we are increasing our mix of subbies to DLO, of course, we need that information quickly to continue that order to cash cycle. So really exciting from the CRM, the web-based system. There's other stuff that we're doing, like Find My Engineer. Now that is similar to an Amazon-esque type scenario, where it will allow a text to go into our residents, and residents for us are the key. They're our clients. They're the people that we need to provide the service to. So it will keep a resident updated with an ongoing text, and then at the end of the job, it will allow them to fill in the resident satisfaction form, and that will then feed straight back in again to our system. And I'll pick a final one out on there. We're looking at some video diagnostics, where it allows us to go into voids in particular, and we've got some clients where they're slow from a post-inspection and an IVR status. So we've said to them, we'll go in, we'll take a video of the void initially, we'll then do the work and rerun the video. We'll put the schedule of what work has been carried out, and we'll send that to you so it's visible. So it will minimise the need for our clients to go out and go around all these voids, because it will be clearly visible in the videos that we send them. And I'll finish on the ESG. David again touched on it earlier, but there's been a reduction in our carbon emissions, and the fleet, like David again said earlier, from the 4%, it will be increased to the 10%. Alongside that, we're implementing the back office system that complements that, and we're now rolling out the home charging units for our engineers, so that they can charge their vehicles overnight, and that again reduces that efficiency and that productivity as the engineers are out in the electric vans.
Thank you, Lee. So we move on to the final slide before we obviously open the floor up in terms of questions. In terms of the organisation where we are, you know, we continue to benefit from our clear and defined strategy. Legislation drivers are certainly positioning the business well for future growth. When you combine that with the direction of the strategy, we do have a robust pipeline of further opportunities in terms of both direct contract wins and awards under frameworks that we hope to share with the market in due course. And we will continue to drive efficiencies to improve our productivity and profitability. You know, the resilient and robust quality of our earnings offers the positive outlook. Clive covered this earlier, with 64 million of our 3-year revenues anticipated to be recognised in FY24. 98% of the visible revenues being recurring, and obviously the index linked providing additional assurance in terms of our term contracts. Without question, the pressure of compliance and costs on clients, coupled with our framework award wins, will position us and does position us well as a potential partner solution provider, particularly with Lee talking in terms of those accreditations and us being able to offer one, the ticket, but two, the one-stop shop element with regards to these will undoubtedly put us in good stead moving forward. I mentioned again, you know, the labour challenges within the sector over the short to medium term, but that provides us with an opportunity. not only do we have a pipeline of staff coming through in terms of apprentices, but our hybrid model with both direct labour and subcontractors. And as I mentioned earlier, the continued diversification of that subcontractor portfolio will serve us to minimise that impact and capitalise on the challenges for the wider market. So in summary, the board, remains confident as we sit here to deliver a strong performance going forwards.
David, Clive, Lee, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated in the right-hand corner of your screen. As you can see, we received a number of questions, both pre-submitted and throughout today's presentation. And if I could just ask you to read out those questions and give responses where it's appropriate to do so, I'll pick up from you at the end.
Thank you. So the first question we got here, there was a couple of questions relating to this, and the question is that you stated that the board is exploring partnerships and other strategic opportunities. What kind of opportunities are you considering? So there is an umbrella of scenarios within here when we're looking at in terms of partnerships, and I'll give a few examples of these to give the context and perspective. So one is, for example, there are people in the market that have approached us where they are looking to submit a rather large tender portfolio, and with that want some specific help relating to elements of our service divisions. So there is one perspective in terms of this partnership strategic opportunity where there is a consideration for us to look as a partnership on a larger bid and having sole focus and part and parcel of that bid. Like I said, with regards to our pipeline anyway, the numbers would need to stack up very substantially for us to need to do that, because we have enough in terms of the pipeline of opportunities directly for ourselves. Flipping that coin the other way, with some of, particularly on that renewable side, whilst we have that 2030 installer accreditation, part and parcel of that, and I believe it's past 2035, is a design and planning status. So flipping the coin the other side, we are looking at potential partnerships in that regard, again, to offer that whole package to a potential client in terms of the design and planning, as well as then the implementation piece that we already hold the ticket for. And another example of this is where our audience may well be aware of the prevalence and concerns relating to mold in social housing. So we are currently, the traditional method of this is to go into a property and wipe the mold down with bleach. Clearly that is a sticking plaster. The fundamental root cause on this is ventilation. But as part and parcel of addressing the issue in terms of mold itself as well, we are trialing some proprietary technology where you wipe the walls down, you put this wash on, and it's followed by a top coat, which has a longer lasting, more residual effect to help get to that root cause of the mold itself. So that is another example of where we're looking at partnerships. Now, matters out of that, where that example as one, maybe if we see sufficient traction and opportunity within that, of course, we'll explore potential acquisitions as part of that partnership profile. But it is a very broad perspective in terms of our partnerships and strategic opportunities. So hopefully that answers the question or questions that were asked relating to that. If I move on to the next question, this was pre-submitted as well. I think we've covered this to a certain extent. Why did the group's gross margins improve from 23.9 to 26.3 last year despite cost pressures? Was it because of a change in the mix of the business towards higher margin electrical work? I think Lee has covered that obviously on a previous slide, so we'll pass through that. The next question, congratulations to you and the team for the hard work that led to these excellent results. So thank you for that. Regarding the chairwoman stepping down, you stated that this would disrupt the added value for all stakeholders. Please explain how this added value will be disrupted by a chairperson change, given that the business is now stabilised and the DCB projects on their way to completion. To be honest with you, I think the answer is given in the question. The fact that we have had that stability during this very important transition process has indeed contributed to the stabilization of the business, and 7 of the 9 projects being on their way to completion, with an expected conclusion on those 7 projects within the financial year. Of course, we still have 2 to go, and as we've said earlier, we expect to close these contracts and get on site as soon as possible. But as I said, I think the very fact that the business is stabilised, we've got 7 in play to complete by the end of the financial year, is part and parcel of that rationale in terms of that stabilisation as we've gone through that transition period. Moving to the next question. The group's average wage and salaries per employee grew by 17% last year. This seems very high. Was it due to an improvement in the skill mix of employees? Clive?
Yeah, I see that actually is a very positive question to ask. Actually, I think we'd be probably quite proud actually of that actually as a position. I think we've covered probably quite a lot of the things in the presentation in terms of the underlying pay rises that went through about 5% in the year. There was also reference as well around progression and upskilling, and also investments in the business, certainly in terms of commercial and our business development teams. So very much, and also investments in sort of more senior management as well, and infrastructure. So actually, I think that actually is a big driver to that. I think it's a big driver to actually our success, and so I think we're probably very positive about that actually. And I think the final element as well, which we haven't really covered on too much actually, is around performance-related pay. So we do around the group, and this is a part of that retention and incentivization and self-financing, I think as well, incentive and career progression to staff, in terms of we do have various profit-related performance conditions, and we've seen that, and we've seen an uplift this year on the back of that 29% uplift in EBITDA. So I think actually sort of self-financing and a self-fulfilling prophecy as well to some extent with that, and that's very much allowed and enabled that focus internally on the commercial bottom line. I think that uplift, I don't think we would necessarily be seeing that going forward, because obviously we had big growth in the year in terms of our EBITDA, and the margins and the targets that we would have on those will then be reset in the current financial year. So I would hope actually that would be maintained, and we will be having that successful year in which we can actually be saying, yes, we have had that continuing performance-related pay that's come into the business, because that will only be reflective upon a continuing growth in the bottom line.
Thanks, Clive. There's a couple of further questions here that relate to you, so maybe I'll pass you the mouse in terms of...
Is that another one? The revenues are up 80... Oh, sorry, no.
Yeah, that's the one. Yeah.
Oh, the admin expenses one. Yeah. So revenues are up 18%. Administrative expenses are up 30%. How does the 30% increase break down into pay raises to existing staff and investment in new staff? So I think we have covered quite a lot of that. I mean, part of that increase in the administrative expenses, Lee alluded to it in terms of the gross profit. There's some remapping in terms of costs into administrative expenses and out of cost of sales, just to rebalance the presentation of internally of our numbers. And I think we covered in terms of some of the other big driver into that is the staff costs, which is obviously a big component element. There'll be a number of other elements, but I think those are the main drivers. So I think we probably have covered that up. Again, I don't think we'll see that level of increase. Certainly, I mean, there'll be, if the growth in revenue, there'll be some level of underlying overheads, but not that level because of some of the matters I've just discussed.
I think this is another one. Well, primarily.
It looks like it's for me, doesn't it?
Yeah.
So
go ahead.
shall I read it? Yeah.
Yeah.
So again, revenues are up 18%. Prepayments from customers and accrued income are up 35%. What explains the disproportionate rise? Yeah, I think to some extent this is actually really understanding our order to cash processes. Oh, sorry, there's a bit more of the. Would there be? Oh no, sorry, that's a different one. Sorry. Yeah, so it's really, I think, really understanding our order to cash. So although our accrued income has gone up, you'll notice that actually our trade debtors have gone down, and that's very much, there is a mix and a timing mix there. Our process, and it's quite a short process, so this isn't over a long period of time, but it's very much we undertake a job. Every month there is a valuation of that job with the client. Once that valuation is approved, it converts into an invoiced job, and then into trade debtors, and then into cash. And that trade debtor to cash actually is quite a short period of time. So actually our criticality is actually that accrued income, that to the valuation issue. So they are a combined amount, and I think that sort of trade debtors are down quite significantly, and the accrued income is up, sort of a comparable amount. And I think it's really around that dynamic of the timing of the valuations and the timing of the invoicing and the timing of the cash. I think that part of that would also be, I think that in the year on one of our significant clients, that we actually, working with the client, actually change some of the valuation and the invoicing dates effectively to facilitate cash. I think I mentioned earlier how important cash is to us, and the logistics of some of those processes are sometimes very tight. So we actually work with the client effectively for their logistics actually rather than ours. I think the only other probably challenge that we have on that as well is in terms of some of the accrued income going up and it converting into the trade debtors is we have some elements within that valuation where there are post-inspection works that go on, and I think some of the elements of the investments and the IT improvements and the conversions are to help to facilitate as well that order to cash process.
Okay. Thank you, Clive. You seem to be flavour of the year, I think, because there's another question now for you with regards to the auditor flags material uncertainty. Maybe you can read that.
Yeah, let me read it out. So the auditor flags material uncertainty related to going concern. It appears that part of the issue is that our banking facilities are only renewed for 12 months. Would there be a possibility to negotiate longer durations to eliminate the material uncertainty? So I guess in the first instance, it would be saying it's a little bit of a frustration for us that actually is there as a material uncertainty, because we have a very strong relationship and partnership with our bankers. That renewal of the facilities, and it is just a renewal. We're not asking for any more facilities. Our 12-month facilities, you know, sort of on our overdraft and our purchasing card, I think that's standard and normalised. We mentioned earlier that actually our longer-term facility, when we needed it, which we don't anymore, in terms of the term loan, has actually been fully repaid. That was over a longer period. And I think with the facilities that we have now, I mean, they are 12-month facilities. That's the nature of them. And you know, I think as we gradually pay off the cost relating to DCB, we will move into a position in which I mean, those facilities will be less of a requirement and less of a focus. But I think I'll just go back in terms of that material uncertainty. I mean, we very much see that as just being as a technical position which has to be referenced. And it doesn't affect the audit opinion. The audit opinion is as it is, and is unqualified, but is an element that just needs to be brought to people's attention, because technically we haven't actually formally renewed the facilities at this stage.
Thank you, Clive. A question in from John B. Tipax 2 is larger shareholder with now just under 30%. Do you have any idea of their intentions? I mean, Tipex, as with all our other shareholders, we have positive ongoing engagement, and we have good relationships with our shareholders. In terms of any idea of their intentions, we're not in a position to speculate in terms of our intentions. You know, our focus is to maintain that positive relationship that we intend to have with all our shareholders, and to continue focusing on the work in hand and delivering our numbers. So hopefully that answers that question. There is a question here from Nicholas S. What excites you most for the coming year, and what worries you most? So in terms of what excites us most, I think, you know, clearly the strategy is starting to bear fruit. You know, we have a lot of opportunities in hand, bearing in mind what we've just talked about in terms of the framework wins and the accreditation expansion. Seeing that strategy bear fruit is positive, and I think those opportunities that lie within the market and sector as a whole is very exciting. You know, I think in terms of what there is to be done in the sector in terms of work is significant. Like I said, the legislation drivers and the decarb drivers aren't going away, and we're well positioned to capitalize on that. So that's what excites us the most. What worries you the most is perhaps how we'll be able to capture and capitalize and maximize all that opportunity and potential that lies ahead of us. Of course, you know, it sits there as potential until you convert it, and our focus is very much on making that conversion happen and translating that into the numbers. Like I said, in terms of workload within the environment and the availability for people to do that work, there is a shortage. We're in a strong position with that, and if there was a worry, is a positive worry in terms of how we'll capitalize and maximize that potential in its full regard. There is another question here now from John B. You've reported KINOVO being now placed on several major frameworks. What and when is the likelihood of these being translated into firm contracts? As we've mentioned earlier, with respect to this, there are a lot of things bubbling in the background, and when is the likelihood of these being translated into firm contracts? Obviously, the only response of when that is when you'll see the RNS with respect to announcements as part and parcel of those wins. But no, we're very positive and bullish in terms of the dialogue that is currently underway, and the potential conversion of some of these scenarios. But obviously, as our audience will understand, once we have signed the relevant paperwork, should we say, is the time that we can be affirmed and confirm that this is when it's happened. So we're working hard on that, and we hope to announce news in due course to the market accordingly. Clive, I think there's the next one is yours.
Yeah. What percentage of the total cost of DCV projects are the two remaining? Are they the larger ones? So they are larger. I mean, and potentially, but not the largest. I mean, I think the couple of ones that we have, the first ones we actually got on site were probably the largest. But in terms of timeline, there is one of them that actually has the longest tail to it, and that's really just because it's really only at ground level, so there's no build to it. So that will go over a long period of time, and that to some extent is why it's outstanding as well, because there's a lot of retendering and recalculation of those costs that have been going on in the background with the expert external QS company that we have retained on this, which gives us a lot of the comfort in terms of where we are in terms of the numbers, and regardless of there, we still got those to go to. So they are not insignificant contracts, and have probably more from a complexity perspective rather than an actual cost perspective. And that's why they're taking longer. And although they're under, we've had some positive discussions around those. They're just taking a little bit longer to get to a contractual position.
What I would add on that long tail one though is that we're looking to get it on a fixed cost basis. So whilst it may have the longest tail, once we're in contract, it will be set in stone. So that will tie it up very, very quickly once we get into contract.
So there is another question here in terms of, can you handle big new contracts regarding workforce availability? I think we covered this earlier anyway, because of our hybrid model and our continuing diversification of our subcontractor base. We're comfortable in terms of the potentials that we have in play with regards to that workforce availability, because we've got that flexibility, like we said, between our DLO and our subcontracting partners. I think if we move into that, then clearly we may need to increase our supervisory responsibilities. We treat our subcontractors just as we do as employees. So obviously, as that grows, then we'll need to expand that. Part of that career development progression process allows that opportunity then for some of our operatives and engineers to obviously fill those scenarios. So we have a pipeline there, which in turn gets filled with the pipeline through our apprenticeships. So in terms of new contracts and what we've got regarding workforce, we're very comfortable in terms of the ability to manage that and that potential. So hopefully that answers that question. There is a question here in terms of what will you do with your surplus cash? Obviously, that is a scenario that we look forward to being in, particularly once we get these projects closed out and moving forward. Again, at this stage, the focus is very much to get into that surplus cash position. And I think for us, that's the priority. And as we approach that, then obviously we can apply deeper thoughts in terms of utilization of that as we move forward. There's a question here with the average sector PE of 12. Why are we trading on a forward PE of 4? Congrats on an outstanding year of progress. So thank you very much for that. With respect to that question and the sector PE of 4, why are we trading on a forward PE? That's not a question that we can answer, because obviously in terms of where we are and where that share price is, that is down to the investment community and potential shareholders. So, from our perspective, recognize that as a scenario. Again, the only thing we can do as an organization, as individuals within that, is to continue to focus and deliver in the hope and expectation that clearly gets recognized with regards to that PE perspective. Do you anticipate the non-underlying items in the current year to be at a similar level to FY23?
I think I actually answered that earlier on, actually. So the answer to that is absolutely no. That's certainly going down. Goes back to the reference to the customer relationship amortization, which is now fully amortized. So actually, no, that will go down substantially.
Thank you, Clive. What is your? I think it's meant to say what is your capital allocation policy? Essentially, as we said, obviously the focus for us is to drive this organic growth curve. I think moving forward, as we've discussed in terms of that element of strategic partnerships, that is another arena we will continue to explore. But at this stage, obviously our focus, as we said, is to drive that strategic investment internally in terms of that organic growth. Alongside that, obviously get the DCB projects completely closed off and done, and in parallel with that, continue to explore along the realms of what I've mentioned earlier in terms of that strategic partnership process, which may include potential acquisitions moving forward along the way. Another question here is, can you explain your working capital cycle, please? Clive.
Me again. Actually, I think that actually goes back to on the question about accrued income and trade debtors. I think that probably answers the vast majority of that. I think that there's a component element within that in our WIP as well, which we show in inventory, and that's costs that have been incurred on open jobs. So that's the other side of elements that are in trade creditors as well, in terms of jobs that are not yet completed. So I think it's very much driven by that order to cash process, and then matching that around with the trade creditors to make sure that we're equalising that, and that's where we come into the looking at the high cash conversion percentages. And that I think is very much what we do look at in terms of that working capital, sort of those trading balances, if I can call them that, for want of a better phrase, of trade debtors, accrued income, WIP, and trade creditors.
It looks like we've got to the final question from what we could see. How would a KINOVO group in the year 2030 look like? What would you like to have achieved by that time? And what do you think would be the most important drivers, but also the risk to that road? So essentially, I think in terms of where we are with our strategy, in terms of where we are with our service divisions and our 3 Rs, implementing that growth perspective and capturing and maximising that growth potential is very much the focus, and will continue to be that moving forward. I don't see us, when we talk in terms of mechanical, electrical, and building services, there is a ream of service offerings that we provide underneath that. I mean, if we take specifically, for example, on the electrical side, there's a huge amount of work that is fire related, door entry, security related. I think we've emphasized this before. Some of this is held by, in terms of the qualification certifications, by our subcontractor base. There is potential opportunities for us to absorb that within our direct offering, should we say, moving forward. So I don't see us veering outside of our core strengths, and I don't see a need to focus on that. It is broadening and deepening the specialism and offering within those service streams. With that, then, and alongside that, would be an ongoing focus to provide this one-stop shop solution. You can see that start to come through, and I can see where that expansion can come through, which, as we've already mentioned, may involve acquisitions moving forward as part of that growth driver. And so, I think in terms of what we'd like to achieve by that time is that continuous, consistent, sustainable growth path moving forward. So I think, in terms of 2030, that's as specific as we can be in that regard. We are in an industry where, as we have emphasized earlier, that regulation piece will only continue to strengthen moving forward. And that being our foundation, and with that, allowing the regeneration of renewables to come through, will continue to be the driver for us moving forward. In terms of what are the most important drivers, but also the risk to that road, I think important drivers clearly, from where we sit, we're fortunate that we sit in an arena where there is a lot of non-discretionary spend. Because it's compliance-led, regulatory-driven, these are must-haves. So in times of turbulence from a sort of more macroeconomic perspective, we are relatively immune in that regard, and through these economic cycles, because we're dealing with social housing and affordable housing. Unfortunately, it's times like where we sit in terms of the current economic environment where that need is even greater than before. With respect to the balance of that work as well, certainly in terms of the environment climate, we see new build, we believe, will be restricted because of the interest rate scenario and inflation rate scenario. And with that, therefore, the client base will tend to focus on making sure they put extra efforts into maintaining their current stock, which, as Lee has mentioned, is fundamental in terms of looking after that asset and ensuring it's up to date, etc. From a tenant perspective. One of the biggest risks is managing that growth path. I think we need to ensure that we continue to invest in that infrastructure as we take that growth path off and don't run too lean and mean on that. And with that will be the inevitable challenge, clearly, that as we grow, that labour perspective may at some stage start to have an element of a pinch point. But part of that forward-looking view is preparing now for tomorrow, and we feel relatively comfortable that we're in a good position in that regard. So there's been a last one that's been slipped in here. Sorry, last question. What proportion of your potential 23-24 revenues come from your top 4 client contracts?
Yeah. I did in the background see that one come in, so I had a quick look, and I mean, we have a relatively small number of clients. I mean, the nature of our business is that we have large long-term contracts. So actually, we're comfortable with that. So actually for FY23, the top 4 is actually around about 44%. So it's a reasonably high proportion. I think in terms of going forward, I think that we would hope to broaden and sort of gradually reduce that as an overall percentage. But I think more that on the fact of us actually growing rather than reducing the spend with those clients. I think the nature of those clients is pretty robust, and I think that what we're also doing, and so it's sort of positive from our perspective, is that where we have those strong relationships with clients, what we see is that we're able to bring on new work streams within those clients. So sort of broadening and deepening the work that we do with them. So which comes from the relationship, the quality of the service. So I think we're fairly comfortable with where we're at, but I think with the natural growth of the business, I think that might just almost sort of naturally reduce rather than being as a reduction that comes from any reduction in those work streams.
Yeah, I mean, I think we emphasised. Sorry, Leah, I think we emphasised earlier, didn't we, in terms of the last couple of years, that diversification in terms of new clients accounting for 20%. The momentum of our business development team and the prospects that we see moving forward will further diversify that. And as Clive said, whilst the percentages related to those clients in terms of their currents, we don't expect to change much. We expect that overall pie to increase with additional members within the pie, which will naturally reduce that percentage with respect of that proportion. Hopefully that answers the question. So I think, that's the last question. So we're a little bit overrun, but hopefully that was positive in terms of being able to answer all the questions that were put ahead. And that concludes in terms of the presentations and the questions, I think.
Yes, David, Clive, Lee, thank you very much. That you've been very generous with your time and actually managed to address all those questions from investors. And of course, the company will review all the questions submitted today and will publish those responses on the Investor Meet Company platform. But perhaps just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, David, could I just ask you for a few closing comments?
Yes, of course. First and foremost, obviously, thank you very much to everyone for taking the time out of your schedules to dial in and hear our results. Hopefully you've enjoyed the presentation and the respective feedback and dialogue in terms of the Q&A. From our perspective, as we said, we're pleased with the business performance over the last year. But now that was yesterday, so we're on to today and tomorrow. We have a clear defined strategy. We continue to benefit from the ongoing legislation drivers and decarbonisation objectives in terms of the government. We have a robust pipeline of opportunities in terms of contracts and frameworks, and hope to share news in due course with the market in that regard. And again, from our side, we remain confident in terms of delivering a strong performance moving forward. So from my perspective and Clive and Lee's perspective, once again to thank everyone for taking the time to listening in, and we look forward to connecting with you on the next round of presentations in circa 6 months' time. But if any of our investors and/or people of interest do have any further questions or like to get in touch, we have open doors, and please feel free to do so, and we'd love to hear from you. Thank you very much indeed.
Perfect. David, Clive, Lee, thank you once again for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of KINOVO PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.